In an economic collapse, the first things to fail aren't always risky, they're familiar. That's the paradox. People spend their whole lives being told what's safe: cash in the bank, government promises, long-term paper assets with official stamps on them. And then a crisis hits, and the assets that look the most normal turn out to be the most fragile, because they depend on trust, access, and rules staying the same. History is brutally consistent here. In hyperinflations, savings can be wiped out not by a few percent, but by orders of magnitude. In sovereign debt crises, guarantees become negotiable. And when pressure rises, governments reach for the same emergency tools again and again: withdrawal limits, forced conversions, capital controls, policies that don't look dramatic until you're the one asking for your own money back. So here's the uncomfortable question: why do some assets survive every collapse, while safe savings and paper promises go to zero? In this video, I'm going to show you 5 asset categories that repeatedly survive economic breakdowns, and the common assets that repeatedly get destroyed. More importantly, you'll learn the principles behind why they survive, so you can use them responsibly, without panic and without fantasy. But to see what survives, we have to visit the moments when systems stopped behaving normally, and people learned the hard way what money really is. When people say economic collapse, they usually imagine one dramatic moment, like a movie scene where everything burns down overnight. Real collapses almost never work like that historically. Collapse is a process. Sometimes it's currency debasement, where the unit of money gets quietly weakened until prices detach from reality. Sometimes it's hyperinflation, where the public realizes the money is a melting ice cube and tries to spend it faster than it can lose value. Sometimes it's a banking crisis, where the problem isn't price, it's access. Sometimes it's default, where governments admit they can't pay what they promised. And sometimes it's war or regime transition, where the entire legal system behind property and contracts gets rewritten, and the sequence is painfully familiar. First, confidence breaks. Maybe it starts with a rumor, a failed auction, a bank wobble, a political shock. Then come the tools: bank holidays, withdrawal limits, forced conversions, new currency rules, price controls, emergency decrees. The public is told it's temporary, and sometimes it is, until it isn't. Finally, purchasing power gets repriced, not just through higher prices, but through a change in what you're allowed to do. You can see versions of this in Weimar Germany, where money lost meaning in real time; in Argentina, where the rules around bank deposits and currency conversion shocked millions; in the post-Soviet transition and Russia's 1990s turmoil, where old promises died and new systems were born in chaos; in Zimbabwe, where a currency became a warning label; and even in modern Western crises, where liquidity can vanish and guarantees suddenly come with conditions. The key figures change: central bankers, finance ministers, presidents, but the roles stay the same. Savers trying to protect years of work, wage earners trying to keep up, business owners trying to price goods in a currency that won't sit still. And here's the hidden truth most people learn too late: paper wealth depends on trust and access. In a collapse, trust and access vanish first. In crises, liquidity isn't just cash, it's permission. If you can't access it, move it, or exchange it when rules tighten, it isn't really your asset. And here is where it gets interesting: the survivors aren't random. They survive because they sit outside the failure points: currency, counterparties, and control. Here's the mechanism: because once you understand the failure points, the mystery of what survives disappears. Most collapses are not random. They are failures in 3 places. Failure point 1 is currency integrity. Money collapses through debasement and inflation. It doesn't have to reach textbook hyperinflation to do damage. If prices rise faster than wages and savings, the currency is already failing its job as a store of value. Failure point 2 is counterparty promises. A bank account is not a pile of cash in a vault with your name on it. It's an IOU. A bond is an IOU. A pension is an IOU. In normal times, those promises feel solid. In crisis, leverage, mismatched duration, and political decisions expose what they always were: claims on a system that can change the rules. Failure point 3 is legal and political access. This is the one most people don't think about until it hits them. You can own an asset on paper and still lose control of it through capital controls, forced conversions, withdrawal limits, new taxes, account freezes, or regulatory barriers. In collapse, the sovereign protects itself first, not because it's evil, but because it's designed to survive. So here's a simple framework. Assets that survive usually have at least one of these properties: scarcity. They can't be produced on demand by decree. Utility. They are needed regardless of politics, food, energy, shelter, essential services. Control. You can access them, move them, or exchange them without asking permission at the worst moment. Think of a collapse like a house fire. Paper assets are the smoke alarm, loud, dramatic, and full of signals. But they don't protect you. Survivors are the exits. You don't want one exit. You want multiple exits, because you don't know which hallway will be blocked. And here's what they don't teach you. Most wealth doesn't vanish. It gets transferred, through repricing, through inflation, through forced conversions, and through rule changes that shift purchasing power away from the many toward the few. That's why the beneficiaries are usually people with real assets, mobility, information, and optionality, often insiders who positioned before controls tightened. The losers are cash savers, fixed income earners, overleveraged households, and anyone trapped in one bank, one currency, or one jurisdiction. Those who prepared survived, not because they predicted the date, but because they owned assets with fewer failure points. Now let's stack the evidence. 5 asset categories that keep surviving, and the safe things that repeatedly go to zero. Now let's stack the evidence. Across very different collapses, different countries, different eras, the same 5 categories keep showing up as survivors. Not because they're magical, but because they sit on scarcity, utility, or control. Asset 1. Productive land and food systems. In inflation, war, and disruption, food doesn't become optional. Productive land has a brutal advantage. It produces necessities. That means it holds local exchange value even when the currency is unstable. In multiple crises, small-scale production, gardens, livestock, repairable tools became a parallel economy. Land isn't always liquid, and it has risks, but its utility doesn't depend on a central bank press release. Asset 2. Precious metals, especially gold and silver. Gold and silver have played the same role for centuries: portable, scarce, recognized. During monetary breakdowns, they often function as parallel money or as a bridge to the next system. They're not a growth engine, and they can be volatile, but they don't rely on any one government's promise. When paper credibility cracks, scarcity has a way of reasserting itself. Asset 3. Skills and income power. Portable human capital. This is the asset most people ignore because you can't screenshot it in a brokerage app. In collapses, people with in-demand skills can barter, migrate, rebuild, and re-enter markets faster. Skills are also the only asset that can't be frozen by a bank holiday. If the financial system locks you out, competence is still tradable. Asset 4. Foreign currency and diversified jurisdictions. In local collapses, people naturally flee toward harder money, often dollars, euros, or whatever the market trusts more. This isn't ideology, it's survival. Holding some value outside one currency reduces single point of failure risk. Diversified jurisdictions, multiple banks, legal frameworks, or residency options also reduce the chance that one policy change traps your entire net worth. Asset 5. Essential. Businesses and hard asset-heavy enterprises. Businesses tied to necessities, food, energy, repairs, transport, basic services often survive because demand doesn't vanish. In scarcity, pricing power shifts toward essentials. Enterprises holding real inventory or real productive assets and adapt faster than companies built on pure financial engineering. Now contrast that with what repeatedly goes to zero, or near zero in real terms. Long-duration government bonds during high inflation, they look safe. Until inflation eats the real value, local cash savings in hyperinflation, nominally there, practically destroy. Over-leveraged real estate in a credit bust. Leverage turns a downturn into foreclosure. Pension promises under fiscal stress, sometimes paid, sometimes reformed, often diluted, and even bank deposits when access is restricted. They can be safe on paper until you can't withdraw, transfer, or convert. That's the contrast. Guaranteed paper promises are the illusion. Assets tied to scarcity and utility are the reality. If that list feels uncomfortably old-fashioned, it should, because the modern system is built on the very promises collapses love to break. If you're thinking, okay, that's history, but we're modern now, here's the uncomfortable truth. The modern system is built on the same pressure points, just with better branding. Today's parallel is simple. High leverage plus fragile confidence plus policy tools equals repricing risk. We've lived through an era of easy money and massive debt expansion. Now we're in a world where inflation can spike, rates can rise fast, and safe assets can swing more than people expected. Add banking systems that carry duration risk, long-term assets funded by short-term liabilities, and you get a structure that works beautifully in calm seas and struggles when the weather turns. This matters because it hits real people first, not macro charts. Middle-class savers discover that a conservative plan can still lose purchasing power. New homeowners find out that the same house becomes unaffordable when rates move. Retirees learn that fixed income isn't fixed when inflation runs ahead of yields. Small businesses get squeezed by input costs and tightening credit. And anyone relying on one paycheck realizes how quickly a stable job market can change when financing conditions tighten. Now watch the warning signs that mirror the past. 1. Growing acceptance of financial repression, policies that keep returns below inflation to reduce debt burdens quietly. 2. Increased monitoring and regulation of flows, justified as safety, stability, or security. 3. Concentration risk, too much trust in a few safe institutions and a few crowded trades. 4. The normalization of emergency measures, where temporary tools become standard operating procedure. And here's the hidden knowledge most people never get taught. Crises don't need apocalypse to change your life. A few policy changes can do it. A few years of negative real returns can do it. A short period of restricted access can do it. This is happening right now, not everywhere at once, not equally, but in patterns that rhyme with history. And every crisis transfers wealth toward the prepared, toward people with liquidity, real assets, diversified exposure, and options. If you're not paying attention, you'll discover your safe plan was built for a world that no longer exists. So, what does this mean for you? How do you build a collapse-resistant life without becoming a doomsday person? So, what do you do with all this history? Not panic, not hoard, not try to predict the exact month something breaks. You build optionality, because optionality is what survives rule changes. Here's a calm checklist you can actually use. Lesson 1. Diversify across failure modes, not just asset classes. Most people think diversification means stocks plus bonds. That's fine in normal times. But collapses don't only hit prices. They hit currency integrity, counterparty promises, and access. So think in categories. Own some things that survive inflation, some that survive controls, and some that survive job shocks. You're not trying to be perfect. You're trying to avoid a single point of failure. Lesson 2. Reduce leverage before you reduce risk. Leverage is what turns volatility into liquidation. It's what turns a temporary drawdown into permanent damage. In every collapse, the same tragedy repeats. People who were right get wiped out because they were forced to sell at the worst moment. If you want a collapse-resistant life, control debt and obligations first. Lesson 3. Build layered liquidity. Liquidity isn't just cash, it's the ability to act. Keep some cash for immediate problems, but also consider long-term stores of value that don't depend entirely on promises. And most importantly, have a plan for access. What happens if transfers slow, withdrawals are limited, or an institution freezes accounts? Lesson 4. Invest in skills and networks. Portfolios are fragile when systems freeze. Skills create income when markets are stressed. Networks create opportunities when official channels break. In every transition, the people who adapt fastest are the people who can trade value directly through competence and relationships. 5. Think jurisdictionally. One bank, one currency, one country, one income stream. These are single points of failure. You don't need to escape. You need redundancy, multiple institutions, multiple options, multiple paths to stability. So, what should you do with this knowledge? Don't try to predict collapse. Build optionality so you can adapt if the rules change. Because the real lesson of collapse isn't fear, it's clarity. Know what you own, know who owes you, and know what happens when trust breaks. The paradox is still true. The safest looking assets can be the first to fail. Because collapse is not just a price event, it's a trust event, and it's a rule change event. The numbers may still be on your statement, the government may still use the word guarantee, and the bank may still look solid, yet access, purchasing power, and the rules of exchange can shift underneath you. So here's the principle to remember. In every collapse, what survives is what doesn't require permission. That doesn't mean you need to live in fear. It means you build a life with fewer failure points, less leverage, more liquidity, more real-world utility, and more options across institutions and jurisdictions. You can't control macro cycles. You can't control politics. You can't control central banks. But you can control your fragility. And that's what preparation really is. Now I want to hear from you. Which survivor asset surprised you most? Productive land, precious metals, skills, foreign currency, or essential businesses? And which safe asset do you think is most at risk? Drop your answer in the comments. If this gave you a new perspective, hit subscribe and share it. History has the answers. I'll show you where to look. History doesn't reward panic. It rewards preparation.